Hi friends, welcome to another edition of Live with Brent and Lee. So tonight we're talking about what to expect in the housing market for the rest of 2022, and is it throwing the dice, spinning the wheel, or playing blackjack to buy a house? So, are you gambling to buy a home? So that's what we're talking about tonight, Brent. So if you have the first time you've been to our channel, my name is Lee Bricky, and I'm joined by my good friend Brent Starks from United Lending. If this is the first time you've been to our channel, please don't forget to slap that subscribe button, ring that notification bell so you don't miss any of our real estate tips and tours. We try to be here every Wednesday night, but if we miss it, we'll be here another night, right, Brent?
That's right.
All right. So we got a pretty good night planned for you. We're going to go through a few different slides tonight. We're going to start out as we always do, letting you know what's going on with the market. We're going to talk about rates tonight, what just happened with the Fed, because we've had some new rate information come out today. We're going to tell you what's happening with that. And we're going to talk about foreclosures and market crash, because that is a big deal going on right now. I know that I've had clients reach out to me and say, hey, the market's going to crash. I'm going to go rent a house, stay in it for 2 years, and then swoop up foreclosures. I know there's a lot of guys out there on the YouTube right now, social media, talking about a crash coming and here's why, and comparing it to 2008. So we're going to go through all of that with you, and we're just going to give you the facts, and you can come to your conclusion if you want, whatever makes sense to you. But what we don't want to see is buyers sitting on the sidelines for the next 2 years thinking the market's going to crash in Florida, and it doesn't. Now, obviously, we don't have a magic wand, and we don't know exactly what's going to happen. We just follow the numbers. But if you've seen our show before, if you watched any of my videos, I'm a big indicator guy. I watch the market very close. Brent is the same way. And, in a down market like this, there's a bunch of opportunities, but sometimes there are not opportunities when it comes to something like real estate, because we've showed the screen in the past, right, Brent, that as we go into recessions, real estate sells in every recession just about we've ever had. So 2008 was a different situation. I don't have that slide with us yet, but we've showed it before in previous videos. So we have a little bit of a different situation going on today than we've ever seen, where we are seeing that job market is still super strong, and people are still out there spending money. And until the Fed can break the back of the buyers, then I think we're going to keep seeing this market increase. Brent, don't you?
I do too. I'm glad we're going through the figures, because there is a lot of confusion out there, and comparing, like, for example, and we'll go through this later, but the foreclosures, especially, just comparing, how many foreclosures are now versus a year ago when they were illegal. It's not a good,
right.
It's not a good comparison. So in what was going on in 2008, and we'll discuss that a little later, but yeah, I think it's good. Just dialing in the actual facts is so important. The Bible says first get the facts, right?
Right. Right. So if you're coming from somewhere, let us know where you're coming from. We have Costas on. Hey, Costas, how you doing? Thanks for joining us again. If you leave us a comment, tell us where you're coming in from. We love to find out where you are coming from, and drop any questions you may have on what we're talking about tonight, or any other questions you may have. So let's get started by showing you again. I show this to you every week, which is my market pulse, which basically shows you the Virginia for Costas. That's awesome, man. Got to get you down here to Florida soon.
That's right.
So anyways, let's show you the Market Plus. I show this to you every week. I look at it every day. And, we're basically seeing the same thing we've been seeing every single week. The market actually seems to be tightening up a little bit again in South Florida. So this is what you're looking at here is the entire South Florida region from Port St. Lucie to Miami. And you can see the absorption rate here. This is days on the market. Average days on the market for a home is 14 days. So we are still in a really serious seller's market here in Florida. Now, some markets are loosening up a little bit other than more than others, but South Florida is still pretty tight, especially Palm Beach County, Dade, and Dade County. Last week we talked about all the people that are moving from Palm Beach, into Dade County from New York. It's the number one city people they're moving to. So, when you see that kind of migration into a city, what's happening is those people down there in Miami and Broward are coming up here to Palm Beach County and to St. Lucie County and Martin County because they're trying to get out of the hustle and bustle of the city because so many, if you think about it, why would more people be moving to Miami from New York than to any other state? It's because all of the brokerages are moving down there. It's becoming the Bitcoin capital of the world. So we have the last 7 days, we have 2,558 active listings. And if you take the under contract and pending and add them together, we're at 2,098 homes under contract. This number needs to be, as I say every week, 3 times what the pending is and under contract together to have a balanced market. So we haven't been in a balanced market, Brent, in 8 years.
Long time.
Yeah, it's been a long time. And I like to always say to, buyers and sellers out here that, look at the pre-COVID numbers in Florida. We were moving about 3 to 5% in Palm Beach County and about 10% in Port St. Lucie, 3 to 5% in Martin County. So if we just get back to that, we're still in a seller's market because homes weren't sitting on the market for more than 30 days unless there was something wrong with them. And that's what we're seeing today. So let's get into our slideshow here. All right. So nationwide, we are still in a seller's market. So anything under 6 months is inventory is considered a seller's market. And you can see where we're sitting today, where we were, a year ago. This is where we are today, but we're still, this is nationwide. So there are markets right now that are struggling, but nationwide, we're still in a seller's market.
Yeah. It's very localized, even here in South Florida. Miami's very much different than St. Lucie County. So.
Absolutely. I mean, here in Jupiter, even, there's some inventory to buy right now.
Mm-hmm.
So that's the good news is, hey, we all want the market to loosen up a little bit if you're buying or selling, because it gives you the ability to find a home. Hey, it's great to, get 50,000 over list on your home, but if you can't find another one to live in, what's the point, right?
That's right.
So let's start talking a little bit about why we're not going to crash, Brent. So first of all, there's not enough homes, right? We can see it here. This is 2008. We keep going back to this. And there's videos. I've seen some videos on YouTube, and I sent them over to you, Brent. A couple of my real estate buddies have sent them to me. Right. And, people talking about comparing rates to where the rates were in 2008, inflation where the rate inflation was in 2008. But the biggest difference now is what we're going to talk about. Number one, we were in a buyer's market in 2008 when this whole disaster started happening. Now we are here in a seller's market. So that's the biggest thing. And then explain this to everyone, Brent, because, you know, one of the big deals is rates are going to go to 10%, right? And so we saw rates jump. We saw the Fed move today. And tell us where we are with this graph.
Yeah, this is a 6-month Japanese candlestick chart. Actually, it's how the bonds are traded. This is how mortgages are traded every day, and what we look at and watch in real time. And this is 6 months. It goes out 2 years in our service that we subscribe to, but we watch this daily. So we actually just one of those candles, either little green or little red bars, that represents a day. And so I don't want to get too technical on how this works, but very generally, you're looking at 6 months here of mortgages being sold into Fannie Mae and Freddie Mac, and the prices at which they're selling for. And if you'll notice, 6 months ago, it's the very top left there, the candlesticks were up and down, red and blue bars up and down, and you see over months, about 4 months of declines in the bond market. There's an inverse relationship. So as the bond price was going down, rates were going up. And this was during the Fed's talk of raising rates and all of that, and we knew that was going to happen. We knew inflation was a problem 6-8 months ago. So all this, is expected. And so that's when they were telegraphing, hey, we're going to raise rates steadily every 6 weeks or so when the Fed does their Fed monetary policy meeting. And so the Fed spoke today. They increased the Fed funds rate. The rates, it's simply the rates banks charge for overnight funds to reconcile their accounts. But it trickles through the market, if you will. And that was very much anticipated by the mortgage market. And I want to make it really clear to folks that are concerned about this. You can see how even though that bond price is going down about 3/4 of it, you can see those months of where the bond was going down, rates are going up. And you see two, they're called gap downs, actually, where there's some red bars that went way down, and then the bonds slowly start to improve. That means rates are going down with that inverse relationship. So we've got about 3 weeks or more of rates are actually improving. And when the Fed increased the overnight funds rate, it was already baked in the 75 basis points, or 3/4 of 1 point. So rates went up 3/4%. There was a slight possibility it would go up 1%. So now that risk is off the table. Rates actually improved. Mortgages improved, even though rates went up. The Fed funds rate went up because they're not locked together. What is locked to the Fed funds rate is the prime rate. So prime rides 3% above the Fed funds rate, which is now 2.75. So if you have a loan that's tied to prime, credit cards are tied to prime, commercial loans are tied. Car loans. Yeah, some of those you'll see any adjustable installments, those types of things, if they're adjustable, those will all go up. So if you have a HELOC, tied to prime, that's going to go up. And it's going up substantially, obviously. You'll see those go up here in the next several meetings, maybe not as much as they anticipated, but they've got a couple more hikes baked into that rate sheet right now. So one of the things the Fed spoke about today, Lee, in the comments in the media portion that follows the actual statement, is they were talking about future plans, and you kind of get a read on that they're telegraphing, if you will, what they're anticipating, and as opposed to saying, hey, we're seeing specifically several 3/4 hikes before year end. Now they're basically pulling back on that statement of how much precisely. They're saying it's going to be data driven. And I think what they're doing is they're allowing themselves some wiggle room for tomorrow's GDP. When the gross domestic product comes out tomorrow, if that's a negative for the second quarter, that would be 2 quarters in a row, which is by definition for most people, it means it signals a recession. So you hear mixed messages on that. Employment is like at 3.6. Now unemployment's about 3.6, 3.5% right now. And so unemployment's not a problem, that what the Fed's mandate is, they're trying to balance, you know, two things: maximum employment and price stability. That's their mandate. In other words, inflation under control and maximum employment, and the balance between those things. So that's going to be the teeter, you know, the going back and forth on that fulcrum. They're going to say, you know, hey, we got to watch, make sure not too many people are losing their jobs, but by the same point, we need to slow this economy down and bring that excess demand out, inflation, and get prices under control. So that's really the, you know, the conversation now. What's going to be in the news cycle, inflation or unemployment?
Right. And so, you know, speaking of that, so something that's really weird going on in the market right now is that situation.
Mm-hmm.
So, you know, we're seeing a real split in the market where the higher end properties are still flying off the market, and the lower properties like the 300s are really, you know, they're sitting for a little bit longer.
Mm-hmm.
And I actually think that's because of rates, right? You know,
Mm-hmm.
FHA and, you know, conventional rates are much higher right now, so it's priced a lot of people out of the market.
Mm-hmm.
Where the bigger properties, people are throwing down so much cash. They're coming from other states. They're
Right.
buying cash. I mean, I'm still seeing cash buyers. So I think that, you know, they're breaking the backs of everything that's going on right now is breaking the back of the little guy. And we're
Yes.
seeing that, I think, in the real estate market right now, where the money is actually upper middle class, and, you know, big money is moving around and buying up property.
You know, smart money right now, Lee, and 25% of homes right now being purchased are purchased by investors.
Right.
You know, I
And
think,
that's
you know,
hedge funds mostly, I think.
yeah, you know, that's why I'm so passionate about helping people certainly buy their first home, especially
Right.
because it changes your world. I mean, as far as your financial picture, Lee, we've talked about this once. I think it was the average net worth of a homeowner is $300,000, and the
Right.
average net worth of a renter is $800. I mean,
Right.
it's radically different. I mean, that's how people build, you know, wealth for their family, you know,
Right.
and as investors come in, it's just moving more towards towards the situation we have, the haves and have-nots, and that just
That's
makes
not a
me.
good place to be,
It's not. It's
you know,
not.
and these gas prices and food prices are crushing the back of, you know, middle America right now,
It is.
and lower income people.
That's who it
So,
hurts.
yeah.
It's not hurting a
Um,
guy, you know, pulling down $300,000 a year as a senior executive somewhere. You know what I mean? It's not.
right.
You know, it's hurting the guy, the blue collar worker that's working, you know, 8-10 hours a day to support his family.
Right.
So.
Right. So, talking about that, you know, that's really, I think, what we're trying to get across tonight. We're not just trying to, you know, hey, you know, I'm in real estate. If you're looking to buy real estate anywhere in Palm Beach County or Treasure Coast, you know, we'd love to sell it to you. But more importantly, if we're sitting here talking to people about, you know, you really need to put your thinking hat on. And
Mm-hmm.
when you're hearing, you know, market crash, 2008, all this stuff, and you're looking at buying investment real estate here in Florida or a home here in Florida, you really need to follow the indicators. And we're going to show you some more stuff tonight that the indicators are saying that, you know, a crash is way, way far away. If you know, and, you know, obviously we can't wave a magic wand, but if, you know, if you're buying a home to live in it, and let's say, you know, we do go through a market crash, I mean, the money that was lost in 2008 is back now.
Mm-hmm.
I mean, that's the thing. The houses that, you know, we're seeing housing prices now to the 2008 market, and some even more. So, you know, having a home and being a homeowner, I think that you know, and you know, you're not really rolling the dice, right, Brent? If you're buying a home that you're planning on staying in, because even if the market falls back just a little bit, prices slow down a little bit, you know, you own a home, and eventually that equity is going to come back,
Right.
correct?
Absolutely. Real estate isn't a get rich quick scheme. It's just not. It's a get rich slow scheme.
Yeah, and I
And,
think that people have really gotten to we've seen this for 3 years and we get so used to things like, 3% mortgages and
yeah,
home sell, going up 30, 40, 50%. It's not a normal world when that's happening. And we're
right.
going to see pain come out of that. But what I think a lot's going on in the internet right now is a lot of fear tactics. And, in my opinion, shame on you if you're doing that, because I think that you're scaring some buyers into not buying. And, here in Florida, you can't find a rental. And,
No,
and for what you're paying for a rental, you can buy a home at the rates we're at right now.
yeah.
So let's show them like this lending standard thing.
Oh, yeah.
So this is the mortgage credit availability index. So explain this to everyone, Brent.
Yeah, this is put out by the Mortgage Bankers Association, and basically it looks at the criteria for lending guidelines. In other words, underwriting guidelines, how strict they are. So it takes into consideration debt ratios that are acceptable, the way income is shown, either full documentation or bank statements, that type of thing. And if you look in 2005, 2006, that's when underwriting standards were such that you literally could have a 580 FICO score and by which is a lower credit score towards the lower end, some pretty significant, credit instances where, pay history was insufficient. Typically, we wouldn't even think about doing a loan at 580 right now for a conventional loan. But FHA, we can go that low because of the insurance. The Federal Housing Administration's insurance covers it. But then you could basically state your income, Lee. You could basically tell the lender how much you made, and they believed you. Wrote down on a piece of paper, okay, we'll take that. And so your stated income, the credit score was 580, and you could put zero down. You had no investment in the property. There was no skin in the game. So when prices started to drop, what happened is the crash happened because people had nothing in it. They didn't have a history of paying payments, and they stated their income. You know what I mean? It's
Right.
kind of a perfect recipe for bad loans because the loans are based on three things: credit, income, and equity in the property. So your down payment. So that large down payments limits the risk. All three legs I call it three legs of the loan, and all three legs are wobbly. You know what I mean on those loans. And so
Right.
when they couldn't make the payments and they adjusted, further accentuate the problem, they were two-year
Gas
fixed
prices
loans.
jumped up.
Yeah, well, yeah, exactly. Two-year fixed loans. So in other words, the rates went up, so their payment went up after 2 years, and they
Right.
couldn't. You know what I mean? So hey, well, honey, we didn't put anything down. Let's just move. You know what I mean?
Right.
So all the
And for some
foreclosures.
people, they lost so much equity, it made sense for them just to walk away from the house because they were so upside down on it. It was the thought
Absolutely.
pattern back then. It would take them years to get out from under the house. So CPAs were telling people to walk away from their homes.
Walk away from them, and they actually were paying people to leave if they just leave them in good order. There were
Right.
so many foreclosures. People would call into their bank and try to work a modification. They said, you know what? We don't even have the manpower to do it because there were so many.
Well, loans were lost, all kinds of stuff
Oh,
happened.
the
Paper.
rubber.
We dealt with that for, up to about 3 years ago. We were still dealing with people when they dig into people's lives, they would find these mortgages where, like we had the one client, she didn't even know her husband had bought houses. He bought 3 of them.
Right.
And she had no idea she had done it. So what we're seeing here is we're seeing, the standards of mortgages at the 2006, it just, everybody was able to get a mortgage on stated loan. Now we're way down here and you can see the line where they tightened up mortgages and, there's some new little programs out right now. We've talked about them like stated income. Bank statement
Bank
loans,
statement
things like that. But you got to prove you have money to get a mortgage, and then you're getting knocked over the head with the interest rate on that kind of stuff. So you're not just buying a house and not proving that you can afford it these days. So,
Right.
let's just cap this as we move along. We're low on inventory, right? We're in Florida here. We have 2 weeks worth of basically homes sitting on the market, right? So by the time you list the house, show it, and get it under contract, there's your 2 weeks, you know.
Mm.
So, you know, we're 2 weeks as averages of absorption rate. And then we just, there's no bad paper on the street. So,
We have 14 years of full documentation, hard to get loans. You know what I
right.
mean? 14 years of loans out there that are all vetted, you know, and there's then, by the way, in 2007, 2008, there was record low as far as, you know, in modern times
Right.
equity. And now there's all time high equity.
And
In
then the
other words,
2008 crash, we were in a buyer's market, not a seller's market, where we're in a seller's market
right.
right now. And then we go to new construction. So we're seeing new construction start to pull back a little bit.
Mm-hmm.
So building permits have reduced here for June. Housing starts have reduced. So these two numbers right here show us that, you know, the builders are pulling back a little bit, and that tightens the market up even more. It's not
Mm-hmm.
like they can go build a house in a month and catch up. They've got a little PTSD, I think, from 2008. They're not taking any chances.
Right.
So the market's tightened up. Now, while we're on this new construction right now, I'm putting out a new video this week on new construction on some pitfalls. But on the positive side of this, especially in Port St. Lucie, where we're seeing a ton of new construction, there's opportunities to negotiate now
Mm-hmm.
on the lots. There's opportunities there's a lot more incentives to buy right now. A lot of the builders are willing to let you go to outside lender or pay cash and still get the incentives. And for a lot of people, they don't understand that that when you buy a new home, the builder is charging you the title policy. So that title policy is that's something that can be negotiated now too, of having the lender pay the title policies, because if you go and buy a home on a resale, the seller's paying the title policy. So
Mm-hmm.
there's some opportunities here to negotiate on on this new construction right now.
And this is healthy. I
Healthy.
think, yeah, you don't want 20% appreciation every year. You don't want a market like that. You want it to come back into balance. And, I hope that the Fed can manage kind of a soft landing here. As, rates have really done, increases, or projected rate increases have pretty much done what they're supposed to do. The final thing is really getting the excess demand out of the economy with all the stimulus money that was thrown out there. I
Right.
think that's, a lot of people got some large checks, you know what I mean? Business owners for the PPP money, the payroll protection plan and all that,
Right.
And that provided down payments for folks. So it created some excess demand. Boats were selling off, used boats were up 30-40%. You know what I mean?
Yeah,
In price.
crazy,
Used
man.
boats. Yeah. Here in Florida. So, there's some excess demand there that's got to get, kind of fleshed out.
Right. And then we're looking here at foreclosures. So last week we were, 700% more foreclosures on the market. We're hearing that number, right? So here are the real numbers on foreclosures, right? This is where we're sitting right now nationwide for foreclosures. This is where we were at, 2008, 2009, 2010. You can see it started to dip. Now it started to grow. And then and this follows the other chart we were showing you, as lenders tightened up their lending and what they needed from what's the word I'm looking for, Brent?
Yeah, they're lending guidelines, underwriting
Their guidelines. Yeah, the underwriting guidelines. You can see how the foreclosures drop. Now we're seeing a little bit more come up right here, but this is recessionary, But if a foreclosure hits the market, unless these people sucked all of their money out with a refi, then then they have equity in their home.
Yeah.
So they're going to sell this home on the open market. And if you look at nationwide, we still have no inventory. So it's going to, it's definitely going to get sucked off the market because there's just not enough out there.
Yeah, and we talked about this, 2022 versus 2021, and I think one of the podcasts we saw was up 700% foreclosures. And I think that really is good to show that there were no foreclosures. Basically there was a moratorium on them. You couldn't foreclose on someone during the pandemic, so a lot of that's getting fleshed out now. So I think it's good to know the facts. You know what I mean? Like, yeah, they're up, but historically they're extremely low.
Extremely low.
There's no reason. Why would you have a foreclosure right now? There's some cities in the Midwest that are suffering. They're having a tougher time, but the market here, like you say, 2 weeks, your home's sold. And
there's no way you're getting a foreclosure. If you price it under market, it's going immediately.
And honestly, Lee, I'll tell you what, because I've talked to people, it's situations where there's something going on. So it's so rare, and it's usually family situations where they're just putting their head in the sand. You know what I mean?
Right.
You know what I mean? I hate to say that, but it's really kind of the case. Someone passed away, and it's an awkward situation.
Well, in the graph I just showed, there was 1.6 million in foreclosures in 2010. We have 164,000, little over 164,000 right now in 2022. So Joseph here, answer that question for him, Brent.
What's a good percent for closing costs on a $450,000 house with 5% down? Yeah, if you're at 2%, and it depends. It's going to run closing costs, title and escrow are going to run about that, and it depends if you're throwing in prepaids. So if you're in a mortgage where you're prepaying you have to pay your 1 year of your insurance, your homeowner's insurance, for the casualty loss, fire insurance. And then you're going to pay about 4 months of the taxes if you're impounding the taxes. And we can waive those if you wish, and that lowers your closing costs. So what really is a variable there, a big variable, is because it pretty much in the title insurance, all those things are pretty much set by the Department of Insurance. So what you can do is you can dial up your rate and pay lower closing costs, or actually get a credit to pay them all, possibly, but the rate would be pretty high to do that. Or you can dial it down and have an extremely low interest rate and pay a little higher in closing costs, because you're actually paying points, which is technically prepaid interest. So to answer your question, a 450, in 2% range for closing costs would be good, provided that you have standard, like you're paying maybe a point for the loan, that type of thing, where you're getting a little better rate. So that's in the ballpark.
That answer your question, Joseph? All right. So moving on, if we have no more questions, you're very welcome. Here is a VA client that we just started working with, and she is absolutely wonderful, and we want all the VA business we can get. So
we love our vets.
That's it. That's it. We appreciate
Thank you for your service.
That's it. So thank you for being a part of our little community here, and thank you for reaching out to us.
It's a family of veterans too.
Yeah, we're looking forward to helping you and your daughter. Definitely. So next is forbearances. So this was a big deal, right? We kept hearing a couple of years ago, oh, when the forbearance is in, that's the end of it, right? There are going to be tons of foreclosures hitting the market, and it's going to be a total disaster, and the market's going to collapse and the prices are going to go down. So here are the real numbers. So 36.4% of all the foreclosures were paid in full. 45.2% were worked out through repayment plans, and 18.4% were still in trouble as of June the 30th. So 2022. So, but if you look here, there's no loss and mitigation plans. Short sales, deeds in lieu of repayment plan is 1.2%.
Yeah.
And
these aren't all loans aggregate together.
These aren't all loans. This is just forbearances.
that went into forbearance program.
Yeah, these are people that lost their jobs, didn't have a job, couldn't make their mortgage payment, all of those sorts of things. So
this is a slice of the worst.
yeah, so recap. So we're going to recap it again. We're low, super low on inventory. The last figures I read from CoreLogic said we needed 30% more listings and 300% more new construction. We have new construction pulling back a little bit, but because they're they don't want to get themselves in a bind. We have no foreclosures at the lowest in history, right? Rates are actually improving as mortgage rates are actually improving as rates go up. We have a strong job market still. We have a ton of millennials in the market now that we didn't have before, and they all have good jobs, and a lot of them are being able to work from home, so they're being able to migrate to states like Florida or Texas where they want to be. And then we have forbearances. There's nothing out there.
Right.
I'm just here asking, I don't see the indicators. You can't tell me that rates in 2008 were the same as rates now, and that's why the market's going to crash. Mm-hmm. It just doesn't make any sense.
Right.
I think, if you're holding out in the market, you could end up, looking, especially if you wait 2 years, you could be looking another $1,500,000 on a house. I mean, rates would probably be lower, but
well,
you can always refinance your house, but you can't go get that $50,000 in equity back.
Right. I tell them, really, you're not married to your rate. You date your rate, interest rate.
Right.
You don't, you buy the house. And so it's kind of like, a friend of mine in the Bible study years ago in 2012, 2013, he said, I'm not paying $180,000 for a townhome in Jupiter. And I'm like, I kept telling you got to get in the game. And he's a school teacher, great guy.
Right.
And I just, I've lost touch with him, but sometimes I think about people I just really wasn't firm with and said, you need to do something here. People are moving here in droves, and the prices are just going to go up. Those homes are over 500,000 now. So,
well, I mean, the same house that, we've been doing a lot of stuff under 5 years old. So trying to keep people from getting in that high insurance rate. Right. So
right.
The same house that was 400,000 last year is up, 30 to 50,000 now in Port St. Lucie. And we're still having bidding wars in Palm Beach County. Mm-hmm. Still having bidding wars. So, I mean, something has to happen to make that change. And it's, the problem that, the benefit to the real estate market and the problem that anyone sitting on the sidelines having, I think the biggest deal is that the migration to Florida right now. Mm-hmm. Florida's always been a migration state, but now it's just ridiculous how many people are moving here, and it's not slowing down.
No. And, I talked to a client we've worked with on several transactions, and he's a landlord. And he was telling me this week, he goes, Brent, I feel bad raising rents, but that's just the market now, and I'm a business person. And I said, I totally understand. He's asking, he almost felt bad. He goes, because he owns, 5-6 homes. And it's, it's just, that's just the market here. There's not enough homes. And so, it's like, unless you have a friend that owns a property that's willing to donate to you every month, basically is what it is. That's the only way I know of to find, rentals that are, favorable right now. They're just, you might as well buy a home, first, last, and security deposits, typical here. You're really in a home for that, So yeah, it's like, what are your alternatives? You have to evaluate all of them,
Right. Right. So, that's all I've got tonight. What do you have anything else, Brent?
No, I think that pretty much wanted to cover the Fed meeting today is the big news. And, tomorrow, you sometimes you get a, kind of a whipsaw type reaction in the markets, but the rates actually improved today. Sometimes the day after there's some profit taking. It's kind of a technical thing, but sometimes, rates will, spike a little bit and then it'll start to level out. But generally what we're seeing over the last 3 or 4 weeks is a very slow actual improvement in in the mortgage rates, even in spite of the Fed's hikes. So, and talks of further hikes. So it's all going to be data dependent now, is what they were saying in their media coverage, the new segment that came in afterwards, where they can ask them questions. So we look to see if things kind of level out for a while, and then we'll just see from there. But overall, I just see the market starting to get more normalized, which is a good thing.
Right.
Like I say, yeah, I'd love to see 5% appreciation a year. You know what I mean? Real steady Eddie stuff. You run that out 30 years, and it's a wonderful thing for you. You have a paid off home in 30 years, and your home's worth 4 times what you paid for it. That's a wonderful progression, and I'd
Right.
like to see it get back to that, as opposed to kind of the run we've been on. So we'll see if we can see some stabilization there. I hope we find it soon.
Yeah. So I'll end it up by saying this. I hope that happens too. And, but I do believe that we're going to see the market pick up a little bit in September. I could be wrong, but we are in the slowest time right now, and there's just not a lot of inventory on the market. I mean, there's a lot more than there was, but I mean, in a community, let's say in Jupiter, like the Heights, where there was, a house would hit and be gone, there's five homes over there right now. And there's probably a couple of those went under contract. So, when you're looking at, but you look at Abacoa, it's all overpriced, or there's nothing on the market. So, and in Port St. Lucie, there's more to choose from. There's more on the market, but it's not like, if you're priced well, you're going to sell the house. I mean, if you're in the market, you're going to sell the house. So if you're pricing your home right, you're going to sell, and then you have some options to go buy. I know it's not what, everybody would like to see, but it's better than it was. And I think that we can get some VA and FHA deals done here, hopefully this year, because that's a real benefit to people. There's going to be some new community. There's some new communities starting right now that in Port St. Lucie that are going to be affordable. So if you're looking in Palm Beach County and it's too much for you, or you want new construction, that Port St. Lucie market is going to be a good market for you for a long time. So it's, I like I said, I just don't, we've been here before. We've said it to people before. We've been saying it for 3 years. I can't tell you how many people that have told me the market's going to crash, the market's going to crash, the market's going to crash. And it's done nothing but just increase and blow up.
Yeah.
So, I would not be listening to anyone who doesn't have boots on the ground in this real estate market. And that's who I'm listening. I look at, and then I'm just boots on the ground, selling homes every day. Made a joke the other day with an agent who followed up with me after showing a house. I was like, gosh, it's really nice to have an agent reach out to me and say, hey, what did your clients think of the house? Please give me feedback, right? Because last year, no one did that. We got 15, 20 offers, and we're just calling agents, telling them we're sorry, So, I'd like to get away from that where, we're where we are now, where, there's 3 to 5 offers. So sellers can still do really well, but they can go and find a home to purchase, and buyers can actually get into the market, and there's some opportunity for them. So, do you believe, just to close this up again, there's still talk that rates could come down, at the end of this year, beginning of next year. Do you believe that could happen?
Yeah. Yeah, I do. I mean, I think that, rates are already starting to slowly come down. We were pushing 6% there for a bit, and now we're in the mid fives, depending on the credit profile, right? Because it's really hard to quote rates without knowing, that down payment and, the debt ratio, and of course the credit score. So those are the things that really set that. So it's really based on the individual profile, but they're down overall across the board about almost a full half point from where they were a month ago. And so, and that's in spite of the Fed's projecting, what they're going to do as far as, increased rates. And I think, just if we see, oil starting to come down too, which is a good sign, because that filters through the economy in the form of inflation as well. So, if we see an economic slowdown to the point where, I think, the Fed says, hey, we don't want to, go overboard and might, alter what they what they said they were going to do earlier this year, might alter some of those plans for those next few meetings we have this year,
Right.
with the Fed.
And I'll say this too for new home loaner, new buyers or first time buyers. If you're renting, you're looking to buy, you know, I keep telling people if you're in Palm Beach County, I know that a lot of people like to stay in Palm Beach County, but you can go to Port St. Lucie, purchase a home there. You're going to see a lot more equity there for a lot longer time than you are going to see in a Palm Beach County or where or Broward County, where you're seeing Dade, even where you're seeing prices really getting high, because it comes to a point where they get higher than what people are willing to pay. And so if you're an investor, that Port St. Lucie market is a great market, because you're going to make equity there, and that's what you're looking for, is to grow your portfolio. And then if you're a first-time buyer, there's opportunities coming in the HOAs and tradition, and there's opportunities in the scattered lots for first-time buyers. And I believe that we can get some FHA deals done, and I would try to do it sooner than later. If you're in the market to buy a house, try to do it over the summer, because third quarter tends to be the biggest quarter for real estate here. We do the most, and then the market slows back down a little bit over the holidays, where nobody wants to do anything. But summertime right now, we're able to see that there's some properties available, and we can actually get you in the car and show you 3 or 4 houses that you can actually make a decision on, not just, hey, let's throw an offer on every single thing we see. It's slowed down a little bit.
Yeah.
All right. So if no more questions, hey, thanks everyone for joining us. I appreciate all the awesome comments. We really enjoy doing this, and don't forget that you can hit us with comments and questions after tonight. We'll answer all those on the video. And also, again, if you have never subscribed and you're on this, please don't forget to slap the subscribe button, ring that notification bell, so you don't miss any of our real estate tips and tours. By the way, there is a workforce housing happening right now. Mattamy Homes is building it in
It's great.
in Lake Worth. It's really, really, really affordable. Like, some of it's under $200,000. So if you know someone, they have to qualify for it. I have all the information on that. Hit me with a comment, and we can set up a time to talk. But if you know anybody that is priced out of the market, they're freaking out, they need to work, they need to stay in the market, they need to stay in Palm Beach County. Mattamy's building this workforce housing, and it's going to be really, really nice, and it's going to help a lot of people. So pass this video on to your friends. Tell them to watch the end if they're looking for affordable housing, and we'll see if we can't fit them in the guidelines. I think these are going to go really, really fast, and I am probably the only person on the YouTube right now talking about this. So it's a little bit of a secret right now. So
That's right.
I got all the information on it yesterday, and we'd love to be able to send some people over there and help you get into a home, because I know rents are getting really, really hard for and this is, first responders, nurses, construction workers, things like that, anybody that really needs this. So there are some guidelines, like I said, but we're here. So pass it on, pass these videos on to people you love. Don't get stressed out, too bad out there. We're all going to get through this together, and be kind to each other, because it's going to last for a little bit. And, we're going to have 18, 24 months of pain here, I would say, until we get through all of this. but we'll do it together, and we're going to be here for you. We'll do everything we can for you guys, and be kind to each other. And we will see you next week.